3 years ago, the United States flipped a switch and made $300 billion disappear. Not stolen, not seized, just switched off. And in that single moment, every government on earth quietly decided they needed an exit from the dollar system. Most of them have already started. You just haven't been told how far along they are. If this is the first time you're hearing this framed this way, drop a like right now. Because what follows is the data, the mechanism, and the investment implication that most financial media is either too slow or too conflicted to explain properly. Here is what actually happened. On February 28, 2022, Russia's central bank discovered that $300 billion in foreign currency reserves, accumulated over 2 decades of disciplined fiscal management, had been rendered completely inaccessible. A single digital instruction routed through the correspondent banking network that underpins the entire global dollar system froze the largest block of sovereign reserves ever immobilized in peacetime history. Russia still owned those dollars. They simply could not touch them. That distinction, owned but untouchable, rewrote the risk calculation for every sovereign treasury on earth. Within hours, finance ministers in Riyadh, Warsaw, New Delhi, Beijing, and Brasília were all processing the same thought. If it can happen to a country with nuclear weapons, a permanent UN Security Council seat, and the world's largest natural resource base, it can happen to us. What they did next is the most consequential shift in global reserve behavior since Bretton Woods, and the people executing it are not announcing it. If you want to follow this story as it develops every single day, share this video with one person managing their own money. They need to understand this before it becomes consensus. To understand what's actually moving in the global monetary system right now, you need to correct a model that most investors, including sophisticated ones, carry incorrectly. The US dollar is not a physical asset. It is a claim, a digital entry in a ledger maintained by a network of correspondent banks, clearing houses, and custodial institutions, almost all of which operate under U.S. regulatory jurisdiction. When a central bank holds dollar reserves, it does not hold dollars in a vault. It holds a legal right to access those dollars within the framework of the United States financial system. That right is only as durable as the political willingness of the United States government to honor it. February 28, 2022 demonstrated with permanent, documented, precedent-setting clarity that this willingness is conditional. Russia's reserves were not frozen because Russia violated a financial contract. They were frozen because the U.S. government made a unilateral political determination that behavior in a completely separate, non-financial domain justified using the financial system as a weapon. The money still exists on a ledger. Russia just cannot reach it. Every central bank on earth processed that event and asked the same question. What does this mean for our reserves? The answer is visible in 3 years of accumulated data. And the data tells a story the headlines have almost entirely failed to capture. Before February 2022, the world's central banks collectively purchased approximately 17 tons of gold per month. That figure had been broadly consistent since around 2010, when central banks globally flipped from net sellers to net buyers in the aftermath of the financial crisis. Since February 2022, that figure has risen to approximately 60 tons per month, 3.5 times the pre-2022 rate, sustained without interruption for over 3 years. The World Gold Council's most recent survey found that 95% of central bank respondents plan to maintain or increase their gold purchases through 2026. 0% plan to reduce holdings. This is not a trend. It is a structural reallocation. And understanding exactly who is driving it and why is where this analysis gets consequential for your portfolio. There are 4 buyers you need to understand. Each one reveals a different dimension of the same structural shift, and one of them is going to fundamentally change how you think about the dollar system itself. So stay with me through all 4. China is the largest and the most deliberately opaque. The People's Bank of China officially reports gold at roughly 10% of total reserves, a modest figure by major economy standards. The United States, for context, holds approximately 70% of its reserves in gold. But China's official number almost certainly understates its actual accumulation, and the mechanism is measurable. Approximately 57% of all central bank gold purchases globally last year were reported by institutions that publicly disclosed no identity. The entity whose purchasing volumes most precisely match those anonymous flows, when cross-referenced against trade data, Swiss refinery shipments, and physical vault movements, is, by the weight of available evidence, China. The mechanism is direct. China runs a substantial trade surplus with the United States. Those surplus dollars have historically recycled into U.S. Treasury bonds, sustaining American borrowing costs and maintaining the circular flow that has defined the dollar system since Bretton Woods. A portion of those same dollars is now being redirected quietly, consistently, and systematically into physical gold purchased through third-party intermediaries and transferred into vaults inside China's own borders. Gold that, unlike a treasury bond, cannot be frozen by a digital instruction from Washington. Poland is the second buyer, and Poland matters because it destroys the most common objection to this story. Poland is a NATO ally, a European Union member, a country with no adversarial relationship with the United States and no historical reason to distrust dollar reserves. And yet Poland's central bank governor stood before the press and explained new gold purchases by citing, word for word, national security. Finance officials do not use those words in peacetime without precise, deliberate intention. Poland sits on the eastern border of Europe. It has watched closer than nearly any other country what it looks like when frozen reserves and financial sanctions are deployed as instruments of geopolitical pressure. Poland's conclusion that sovereign gold held in its own vaults provides a security guarantee that dollar reserves, regardless of the strength of the U.S.-Poland alliance, fundamentally is the logical endpoint of any government that has been paying careful attention since February 2022. Now, Saudi Arabia. This is the one that changes everything. And I want to frame it correctly before I show you what the data actually says. Because if you understand this, you understand why the dollar's structural position is more fragile than almost any mainstream analysis acknowledges. In 1974, Henry Kissinger negotiated an informal but historically decisive arrangement with the Saudi royal family. The terms were straightforward. Saudi Arabia would price its oil exclusively in U.S. dollars, ensuring that every country on earth requiring energy would first need to acquire dollars to buy it. Saudi Arabia would recycle those oil revenues into U.S. Treasury bonds. The United States would provide military protection and political backing. This arrangement, the petrodollar system, is not merely a financial convenience. It is the mechanical foundation of the dollar's reserve currency dominance. It created structural, permanent, price-insensitive global demand for the dollar entirely independent of whether American financial assets were attractive. Saudi Arabia has publicly stated it has not been purchasing gold. Swiss refinery and independent trade flow data tell a materially different story. Analysts tracking shipments from Swiss refineries, which process the majority of the world's gold into standard London good delivery format, have identified approximately 160 tons of gold imported by Saudi Arabia over the past several years, in quantities and delivery formats consistent with central bank accumulation, rather than commercial or retail demand. The architects of the petrodollar system appear to be quietly converting a portion of their petrodollar revenues into the one asset the petrodollar was specifically designed to displace. Let that land for a moment. And if you want daily analysis that tracks exactly where sovereign capital is flowing before it reaches the front page, the subscribe button is right there. No pressure, but this is the depth we go to every single day. The fourth dimension is what you might call the long tail of this shift, and it may be the most important signal of all, because it eliminates the most tempting alternative explanation. Finance officials do not use those words in peacetime without precise, deliberate intention. Poland sits on the eastern border of Europe. It has watched closer than nearly any other country what it looks like when frozen reserves and financial sanctions are deployed as instruments of geopolitical pressure. Poland's conclusion, that sovereign gold held in its own vaults provides a security guarantee that dollar reserves, regardless of the strength of the US-Poland alliance, fundamentally cannot, is the logical endpoint of any government that has been paying careful attention since February 2022. Now, Saudi Arabia. This is the one that changes everything. And I want to frame it correctly before I show you what the data actually says. Because if you understand this, you understand why the dollar's structural position is more fragile than almost any mainstream analysis acknowledges. In 1974, Henry Kissinger negotiated an informal but historically decisive arrangement with the Saudi royal family. The terms were straightforward. Saudi Arabia would price its oil exclusively in US dollars, ensuring that every country on earth requiring energy would first need to acquire dollars to buy it. Saudi Arabia would recycle those oil revenues into US Treasury bonds. The United States would provide military protection and political backing. This arrangement, the petrodollar system, is not merely a financial convenience. It is the mechanical foundation of the dollar's reserve currency dominance. It created structural, permanent, price-insensitive global demand for the dollar entirely independent of whether American financial assets were attractive. Saudi Arabia has publicly stated it has not been purchasing gold. Swiss refinery and independent trade flow data tell a materially different story. Analysts tracking shipments from Swiss refineries, which process the majority of the world's gold into standard London good delivery format, have identified approximately 160 tons of gold imported by Saudi Arabia over the past several years, in quantities and delivery formats consistent with central bank accumulation rather than commercial or retail demand. The architects of the petrodollar system appear to be quietly converting a portion of their petrodollar revenues into the one asset the petrodollar was specifically designed to displace. Let that land for a moment. And if you want daily analysis that tracks exactly where sovereign capital is flowing before it reaches the front page, the subscribe button is right there. No pressure, but this is the depth we go to every single day. The fourth dimension is what you might call the long tail of this shift, and it may be the most important signal of all, because it eliminates the most tempting alternative explanation. 22 central banks reported new gold purchases last year: Kazakhstan, Brazil, India, Ghana, Indonesia, the Czech Republic, Uzbekistan. Countries that share no common geopolitical interest, no coordinated policy, no shared institutional framework, and no unified relationship with Washington. They have nothing in common except one thing. They have all independently arrived at the same conclusion about the risk profile of dollar-denominated reserves in the post-2022 world. This is not a coordinated attack on the dollar. It is not a conspiracy. It is a rational, decentralized institution-by-institution reassessment of reserve policy, made by the people who carry the most complete information about the risks embedded in the current system. When governments with entirely different interests and relationships all reach the same conclusion independently, that conclusion is worth examining very seriously. Now here is why this matters for the price of gold, not in terms of narrative, not in terms of sentiment, but in terms of supply and demand arithmetic that is mechanical, documented, and verifiable. All the gold ever extracted from the earth, every bar in every vault, every coin, every piece of jewelry ever made, is worth approximately $29 trillion at current prices. Of that total, roughly 20% is held by central banks. The planet mines approximately 3,500 tons of new gold per year. At current prices, that is roughly $280 billion in new annual supply, less than 1% of the entire above-ground stock. Central banks at their current pace of 60 tons per month are absorbing approximately 720 tons per year. That is more than 20% of all new annual gold production consumed by sovereign buyers alone, before a single private investor, jewelry market, or industrial buyer enters the equation. And here is where gold's supply dynamic is fundamentally different from every other commodity. When oil prices rise, new drilling begins within months. New supply reaches the market within 1 to 2 years. When copper prices rise, Previously uneconomic deposits become viable, and production increases. For almost every commodity, a price signal eventually generates a supply response that restores equilibrium. Gold does not work this way. Developing a new gold mine requires permitting, exploration, construction, and operational ramp-up spanning 10 to 15 years before meaningful production begins. The mines that will supply the market in 2035 are being approved right now. The mines being approved right now cannot meaningfully increase 2026 supply. The supply is structurally fixed for the foreseeable future. The demand has tripled. This is what a structural supply-demand imbalance looks like in its early to middle stages, not at its resolution. Here is the reframe that I think most investors urgently need, because the wrong question is actively costing people money right now. The wrong question is, has gold already moved too much? Should I wait for a pullback? The right question is, what is the structural force driving this move, and has that force changed? Gold moved from approximately $800 per ounce in February 2022 to a peak of roughly $300 in early 2025, a move well over 80% in 3 years, driven entirely by the structural buying I've just described. During every correction along the way, the comment sections filled with declarations that the thesis was broken, the bull market was over, the bubble had popped. And during every single one of those corrections, central banks did not stop buying. China's accumulation did not pause. Poland did not abandon its national security framework. Saudi Arabia's refinery flows did not reverse. The price moved. The structural force did not. The historical parallel worth understanding here is not 2008 or 2011. It is 1974 to 1976, the midpoint of the greatest gold bull market of the 20th century. From 1971 to 1980, gold moved from $35 to $850 per ounce, a 2,400% move over 9 years. In the middle of that move from late 1974 to mid-1976, gold fell approximately 50%. 50% during the single largest gold bull market in modern history. The investors who sold during that correction missed the subsequent move from $110 to $850. The investors who understood that the structural forces, the abandonment of the gold standard, the fiscal expansion that followed, the inflationary consequences, had not changed during the correction, held through the volatility and captured the full structural move. The structural forces today are arguably more powerful than those of the 1970s. In 1974, U.S. national debt stood at approximately $500 billion. Today it exceeds $36 trillion, with roughly $1 trillion added every 100 days. In 1974, central banks were net sellers of gold. Today they are buying 60 tons per month and have publicly committed to accelerating. In 1974, the reserve currency system had never been weaponized against a major sovereign power. Today, that weaponization is a documented, precedent-setting reality incorporated into the risk frameworks of every treasury on Earth. Let me be direct about the 3 mistakes I see investors making right now, because each one is measurably costing real money. The first is confusing a paper market correction with a change in the underlying investment thesis. When gold corrects, and it will multiple times, because paper markets always generate corrections, the instinct is to interpret the price move as a signal about the thesis. It is not. The thesis lives in the structural forces, the rate of sovereign buying, the trajectory of U.S. fiscal deficits, the permanence of the February 2022 precedent. None of those changed during any correction to date. The price changed. The thesis did not. The second is treating a gold ETF as equivalent to physical gold. They are not the same instrument, and the distinction is precisely the lesson of February 28, 2022. A gold ETF is a financial claim, a paper instrument backed by a counterparty operating inside the U.S. financial and regulatory system. Central banks do not buy gold ETFs. They buy London good delivery bars and store them in vaults they physically control, specifically because a paper claim is only as reliable as the counterparty honoring it. Physical gold held in fully allocated, independently audited, segregated custody has no counterparty. It cannot be frozen, sanctioned, or switched off by a digital instruction from any government. For investors seeking tactical price exposure, ETFs are a legitimate and cost-effective tool. For investors whose thesis is structural, buying gold as insurance against dollar erosion, fiscal excess, and reserve system instability, the physical instrument is the only vehicle that actually expresses that thesis. The central banks are demonstrating this through their behavior, not their statements. The third mistake is concentration. Gold does not generate cash flow. It does not compound. It does not pay dividends. It is an insurance policy, a store of value that preserves purchasing power across monetary system transitions. Insurance is not meant to constitute your entire portfolio. It is meant to protect the rest of it. The institutional consensus across sovereign wealth funds, endowments, and long-duration family offices is that a 5% to 15% allocation to gold is appropriate as a structural portfolio component. Within that range, the right number depends on your existing exposure to dollar-denominated assets, your time horizon, and your ability to hold through the volatility that every multi-year structural move generates without making decisions based on short-term price action. The structural force at work here is the most significant sovereign reallocation of reserve assets since the Bretton Woods Conference of 1944. It is not a coordinated geopolitical campaign. It is a rational, decentralized, institution-by-institution response to a single documented event that permanently changed the perceived risk of holding dollar-denominated reserves. Every subsequent month of fiscal deterioration, geopolitical tension, and reserve currency weaponization makes that reassessment more entrenched, not less. The $29 trillion above-ground gold market is not large relative to the scale of global reserves-seeking alternatives. At 60 tons per month of central bank absorption, sovereign buyers alone are consuming more than 20% of all new annual production. Private demand, industrial demand, and investment demand are entirely additional. The supply response is constrained by a decade-long capital cycle that no price signal can accelerate in the near term. The full repricing of a world in which 60 tons per month of sovereign demand has been permanently redirected from dollar assets to physical gold has not yet occurred. At $1,800 in February 2022, gold was pricing a world in which dollar reserves were the unquestioned safe haven of sovereign wealth. The price today is beginning to price a world in which that assumption has been fundamentally and permanently revised. The gap between where price is and where the structural shift implies it should ultimately go has not closed. The transitions are slow until they are fast. The repricing is gradual until it is sudden. The investors who are positioned before the sudden phase are the ones whose portfolios, in retrospect, will look like they made an obvious decision at an obvious moment. In the present, those decisions never feel obvious. They feel early, uncomfortable, and uncertain. That discomfort is precisely what being ahead of consensus costs, and what it is worth. The data is public. The flows are measurable. The structural forces are documented. If this analysis gave you a clearer picture of what is actually happening in the global monetary system and why it matters for your financial position, share it with one person who manages their own investments. Leave a comment below with the detail that surprised you most: the Saudi Arabia data, Poland's national security language, or the supply-demand arithmetic. Every comment helps more people find this before the mainstream catches up. And if you want daily analysis at this depth, tracking the capital flows that move before the headlines do, the subscribe button is there. No pressure. But if today's breakdown was useful, there's more of this every single day.